The income statement reports the effects of transactions that affect net income. Net income is your profit. Revenues are the amounts charged to customers for sales of goods or services provided. Expenses are the cost of business activities undertaken to earn revenues. Expenses include wages, rent, insurance, electricity, gas, the cost of what you sell, which we call the cost of goods sold, and many more. The operating activities of running a business in a typical operating cycle are as shown. Think of running a restaurant. You buy goods and services, and then you pay for them. Then you sell those goods and services to the customers. The customers pay for the goods and services they bought. And then the cycle repeats itself as you buy more goods and services and make sales to customers. You can see where problems could develop. If customers don't pay, then you will not have cash to pay your suppliers for more stuff to sell to more customers. In this chapter, we define cash basis and accrual basis accounting. Cash basis accounting reports revenues and expenses when the cash is paid. Accrual basis accounting reports revenue when it is earned, the service is done, or the item is delivered, and expenses when they incur, when they happen. In other words, under accrual accounting, you record the revenue when it happens. For example, if you own a landscaping business and you mow a lawn in June and get paid in July, you would record the revenue in June. If your employees mow the lawn in June and you pay them in July, you would record the salary expense in June because that is when the expense was incurred. Generally accepted accounting principles call for us to use the accrual system of accounting. That is very important to remember. In recording revenue and expense, we also consider an accounting principle known as the matching principle. Under this principle, we try to record the expense in the same time period as the revenue is earned. Think about this. If I charged $50 for the lawn cut in June, paid in July, and my employees' wages were $20, I would want to record lawn revenue of $50 in the same month I record the $20 wages. So I show a net income of $30. Timing in accounting is very important. In the previous unit, we introduced the T account with debits and credits and used it for the asset, liability, and equity accounts. We expand that discussion to include revenue and expense accounts. Remember that debits are shown on the left-hand side of the T account and credits are on the right-hand side. Previously, we set up a T account for all our assets, liabilities, and equity accounts. We will now add revenue and expense accounts. Debits increase an expense account. Credits decrease expense accounts. Credits increase a revenue account. Debits decrease revenue accounts. Once again, debits increase an expense account. Credits decrease expense accounts. Credits increase a revenue account. And debits decrease revenue accounts. However, it should be noted that credits to expense accounts and debits to revenue accounts are not part of the normal operation of a business and are rare. And remember, the left side is always the debit side, and the right side is always the credit side, regardless of the type of account. I want to show the accounting entries for the recording of revenue under two scenarios during the month of June for a lawn mowing service. I'm using a lawn mowing business for my examples. The first transaction that I am showing is that during June you mow a lawn and are paid $50 for the job the same day in June that you mow it. The accounting journal entry is a debit to the asset cash. You increase cash as you got paid, and a credit to the revenue account, lawn mowing revenue. When you post the transaction to the ledger, debits will equal credits. The second transaction is that during June, you mow a lawn on credit for $75. You will be paid for the job in July. The accounting journal entry is a debit to the asset account receivable and a credit to the revenue account, lawn mowing revenue. Accounts receivable is an asset account. Even though you will be paid in July, under accrual accounting, you will record the revenue when it is incurred, when it happens, when you do the work, which is June. Then you post the transaction to the ledger. As you can see, the total revenue for June is $125. Under accrual accounting, it does not matter when you are paid. What matters is when you do the work. At this point, I want to introduce the concept of unearned revenue. Unearned revenue is revenue that has not yet been earned. Most of the time, it results from something that is prepaid. If I pay you in June to cut my lawn in July, then in June you would record unearned revenue, but not record the actual revenue until you do the work in July. If I buy a season ticket to the New York Yankees, the Yankees will record unearned revenue when they make the sale, but turn it into earned revenue as the games are played. Another example is gift cards. When a gift card is purchased, it is unearned revenue. It becomes earned revenue when it is used. Unearned revenue is a liability. You owe the work or service. It shows up on the balance sheet as a liability. Normally, it is a current liability. Let's use an example of the purchase of a gift card for $200. The accounting entry would be a debit to cash and a credit to unearned revenue in the journal. The transaction would then be posted to the ledger with a debit to cash and a credit to unearned revenue. Remember, the unearned revenue account is a liability. The unearned revenue balance of $200 represents the amount of the gift card that is unused. You owe that to the customer. A few weeks later, if the customer uses the gift card to purchase $50 worth of merchandise, the accounting entry in the journal would be a debit to unearned revenue and a credit to sales. We post these to the ledger. The balance in the unearned revenue account is $150, which is the new amount that is unused. In essence, we have transferred $50 from the liability unearned revenue to become earned revenue. I now want to show the accounting entries for the recording of expenses under two scenarios during the month of June. Increases to expense accounts are debits. During June, you buy gas for the lawnmower. Your first purchase is for $40 and you pay cash. Your second purchase is for $50 and you charge it to be paid in July. The accounting entry for the first purchase is a debit to gas expense and a credit to cash as cash is decreased. Then you post the transaction to the ledger. The second transaction is when you charge the gas purchase. The accounting journal entry for that transaction is again a debit to gas expense. However, the credit is to the liability accounts payable. This is a liability that you will pay next month. Then you post the transaction to the ledger. Total expense is $90. Now let's jump to July. You pay the $50 that you owe in accounts payable in July. The July journal entry would be a debit to accounts payable for $50 and a credit to cash. You now post the transaction to the ledger. As you can see, the debit to accounts payable in July brings the balance you owe to zero. Also in July, you are paid the $75 owed to you. The July journal entry would be a debit to cash for $75. You now have the cash, and a credit to accounts receivable. You now post the transaction to the ledger. As you can see, the credit to accounts receivable brings the balance owed to zero. We previously introduced the trial balance. At this point, we call it the unadjusted trial balance. The unadjusted trial balance is a list of all accounts and their unadjusted balances and is used to check on the equality of recorded debits and credits. Debits must equal credits. As we progress in the course, you will see that this is one of three different trial balances we use in the accounting cycle.